Hey, so what's up? This is Greg. Welcome to DLA Markets. In this video, I'm going to talk about basically three things. One, I'm going to talk about the market since the Fed rate hike, or the most recent Fed rate hike. The second thing is I'm going to talk about the Fed statement and how it was interpreted, and Powell's comments were interpreted by the market, both since then and currently. And then I'm going to talk about how once again the market got ahead of itself and retail investors got fooked again by professional investors and got tricked into a bear market rally where they're ultimately going to get screwed again because we're still in a bear market. Okay, so if you get value out of this, please like and subscribe. And here we go. Okay, since the Fed announced on February 1st that it was going to raise the Fed funds rate an additional 0.25% or quarter of a point, the market has been generally in a rally mode. Actually, the rally started as early as January 19th, you could argue, and culminated shortly after the Fed announcement, where it continued to rally quite strongly. Now, to Powell's statement, and I can't blame Powell for his statement because the poor guy's doing the best he can. We all know the Fed has screwed up repeatedly in advance of when they were actually started to tighten with the inflation is transitory argument. But the guy's been doing the best he can, okay? And my interpretation of his announcement and speech when they raised rates was he was basically saying the same thing he said all along. He was saying, number one, the Fed is going to continue to raise and tighten credit until you get down to 2%. That wasn't different. The Fed said this may take longer than anyone expects, and they may have to keep interest rates higher for longer than anyone expects. And he also said that he's focusing on wage inflation and inflation in the services sector, which does not appear to have been affected by the rate increases as of this point. Now, even though I think that he was just saying the same things over and over again and there was really no change in the stance, the market interpreted his comments as being less hawkish and more dovish. I don't know how they came to this conclusion. There were commentators talking about how, his demeanor was different. The way he phrased things were slightly different. And I think he did make a reference to the policies that they've been implementing have been showing results, which is inflation has started to come down, okay? But the market's interpretation was quite different, and there was a general bullishness came into the market. And what a lot of people don't realize, a lot of the retail investors don't realize, is that prior to the Fed announcement, a lot of the market was short. There were a lot of players in the market that were short the market. So a lot of the rally that was viewed as a bullish signal by many, and I might add many of the less sophisticated participants, much of that rally was due to short covering. But it tended to feed on itself, and by the time you got to the 2nd of February and then the 6th and 7th of February, the rally continued, right? But this past week, a lot of the bullish sentiment and the bullish argument began to break down. Another embarrassing thing from the Fed was right after their announcement, literally days after it, and they agreed to pull back from 50 basis points to 25 basis points. Right after that, the government came out with a blockbuster jobs report where the economy created in the previous month over 500,000 jobs, which completely blew away estimates, which were much lower. This caused people to ask Jerome Powell, if he had it to do over again after seeing the report, would he have changed what he did?
Why don't we start with an easy question? So you made a speech last week commenting on the FOMC's decision to raise the Fed discount rate by a small amount, relatively speaking, 25 basis points. Some people would say that was small. But at the time, it wasn't clear that the jobs report would be as strong as it turned out to be subsequently. Had you known that the jobs report was going to be as strong, would you have done 25 basis points or something different?
David, thank you for that question, and thank you for inviting me here today. It's great to be here. So we don't get to play it that way, unfortunately. We have to, but I'll take it this way. So the message we were sending at the FOMC meeting last Wednesday was really that the disinflationary process, the process of getting inflation down, has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. So the services sector, really, except for housing services, pardon me, is not really showing any disinflation yet. So our message really was this process is likely to take quite a bit of time. It's not going to be, we don't think, smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, as we said, and we think that we'll need to hold policy at a restrictive level for a period of time. Then comes the labor market report for January. And it's very strong. It's certainly stronger than anyone I know expected. And so, but I would say, we didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time. The labor market's extraordinarily strong. And by the way, it's a good thing that inflation has started to come down without it. That has not happened at the cost of a strong labor market. So, and of course, since then, financial conditions have tightened significantly since then.
Now, this is occurring against the backdrop of all you hear in the lamestream media is you see these people coming on CNBC and you hear them talking about the consumer's strong, the economy is strong, everything's strong, there's going to be a soft landing, there's going to be a soft landing over and over and over again. But you see the ISM report that came in, which shows a decline in manufacturing occurring in the previous month. You see the retail sales report showing that retail sales basically collapsed in December, which is seasonally the biggest retail month of the year. That was very negative. You see other evidence that the consumer is suffering, as evidenced by the credit card balances going up and more car defaults happening in the market. You see all these anecdotal evidence, data points of distress in the economy, but yet every guy that gets on there, the consumer is strong, the consumer is strong, the economy is strong, we're going to have a soft landing. The other topic I want to talk about, the last topic, is I want to talk about the retail investor and how consistently the professionals screw them in the stock market, because they basically, for the most part, they don't understand market fundamentals. They don't understand the difference between a bear market and a bull market. And for those of you who are interested in understanding that, I'm going to talk a little bit about that now. Okay, so during this period where the market got bullish, you saw several things. You saw a return of the meme stocks, which I was just absolutely shocked to see. And you saw something like Tesla go from a low of $100 a share, now it's up to $200 a share. So all the retail investors are piling into Tesla again. So you're seeing, even in the face of tight credit, rising interest rates, you're seeing a speculative frenzy coming into the market again, which is causing these rallies. Okay, so for the purposes of illustration, I'm going to go through a couple things here with these charts. Here's where the rally started on the 19th of January in advance of the Fed announcement. The market started to discount that the Fed was going to go to 1/4 of a point as opposed to 50 basis point rise. And then you saw the rally really pick up steam on the 30th of January. Here's where the Fed made the announcement. You see the jump up. There was some couple down days, and then you saw another jump up. And then here, this last week, you saw the market finally come to grips with reality. Let's go. I just want to discuss really just the bear market versus bull market here for a second. Let's go back to 3 years ago. Here you can see this was basically the climax of the COVID situation. This is basically the bottom of the market. And then actually the bottom of the market occurred previous to this in 2020, but this was the bottom in 2021, really when the bull market really kicked in. And you can see, if you look at these lines, there were sell-offs obviously, but the overall trend is up. Okay? That's a definition of a bull market. Higher troughs, higher peaks as you go up. Higher, each trough is higher, each peak is higher, and you reach the peak at the beginning of 2022. That's when reality started to kick in, right? 2022. The Fed started getting more aggressive with their rate increases, the tightening of credit, the stopping of the printing of the $120 billion a month of money that they were injecting into the system. And you can see this is the bear market, okay? Bear market. The trough, each trough is lower. Each peak is lower. Same. And you can see this was the last rally that we had. So it's important to understand as an investor, to understand the overall direction of the market. Are we in a bear market? Are we in a bull market? And I have said over and over again, and I'll say it again here, you cannot have a bull market when the Fed is tightening credit and raising interest rates. That's called fighting the Fed. You cannot fight the Fed. That is a losing strategy. Okay? Basically in 2022, everything was a pile of shit except energy. Okay? If you weren't in energy, you had a down year. Okay? I was in almost 100% energy, and I was up 70%. Okay? In 2022. But if you were not in energy, and you were in meme stocks, if you were in tech stocks, if you were in basically anything else, you lost money, okay? And for most of you, I don't have to tell you that. You understand that because you can see how much your portfolios went down in 2022, okay? As it comes to looking at the market now and where we're going from here, do not be fooled when you see these bear market rallies. These bear market rallies in some case can be very intense and they can be long. But you have to always come back to monetary policy and what is the market telling you, and you have to be cognizant of that, and you have to understand that just like the law of gravity, you can't fight the Fed. Okay? So anyway, I hope this video was helpful to you. If you got value out of it, please like and subscribe. And I'd love to see you on board for the next videos, which will be coming your way very soon.